Hello and welcome to Portfolio Matters. We're back. Thank you to Stuart Owen for covering for us last week. Now, sadly, it's a really eventful period in the markets and not necessarily in a good way. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Okay, lots of news this week. So China has actually started lowering interest rates, and it actually, by the end of the week, it had lowered a few interest rates, but it's lowered all of them by small amounts. So the medium-term lending rate has gone down by 0.1% from 2.95% to 2.85%. So China is worried about a slowing economy and has started to ease monetary policy. In the US, the Fed has confirmed that it will not do monetary tightening in the form of QT, and instead it will stop replacing maturing bonds in its existing holdings and will not sell its bond holdings bought through QE. So it won't do quantitative tightening, selling bonds, and therefore causing bond prices to fall. The bond market has finally woken up, and as we go through this, you'll see there's been an accelerating sell-off in bonds, which has reversed yesterday as the equity markets fell, but there is something to watch going forward and something we've been warning about for a year now. Related to that, the sell-off in the NASDAQ has accelerated this week, and the NASDAQ is not doing well this year. Now, oil prices have had a hell of a run. This week, there was a Houthi missile attack on Abu Dhabi, which and geopolitical tensions are always good for the oil price. And Russia, as you know, is threatening to invade Ukraine, causing Russian and Ukrainian equities to fall. Okay, so going through some economic data, new things this week. First of all, we had a request by regular viewer and fund manager Innocenti67, we know who you are, who has asked us to rearrange this table and put the consensus expectations to the left so it's easy to compare consensus expectations with the actual number. Now, also, we're not going to go through all the numbers this week. What we're going to do is just highlight 3 numbers and talk about those. So if you want to look at all the other data, please pause the video and have a look. Okay, so the first number we're going to discuss is China's balance of trade. So in the month of December, China's balance of trade was a massive $94.5 billion. That massively exceeded expectations. And as you'll see as we go through this, we have some charts showing Chinese retail sales, which have disappointed. That's actually in the line below. Their growth was much lower than expected. And so what seems to be happening in China is that the domestic economy is weaker than expected. And so they're keeping the economy going through massive exports. Now, naturally, that should cause the yuan to appreciate. And the question is, will the China allow the yuan to appreciate? And if not, will the rest of the world get annoyed and start putting tariffs on Chinese goods, which is what happened last time? There are global tensions around this enormous surplus. So something to watch. Okay, next up is good news, a number that unexpectedly exceeded expectations. So we have the flash January EU economic sentiment number. and it massively exceeded expectations. So it came in at 49.4. The consensus expectations were 29.5, and the December number was 26.8. So as the COVID restrictions are easing, confidence is coming back to the EU economy, which is great news. Now, the last number we're going to cover this week is a bad one, and that is the US New York's Empire State Manufacturing Index. Now, the consensus expectations were for a positive 28 number in December, and it came in at minus 0.7, which is a huge drop on November, when it was 31.9. Now, there's a lot going on. We're going to show you the chart in a minute, but manufacturers are suffering from a lot of illnesses, so people not turning up to work. New orders stalled, whereas previously they've been growing strongly. We also had inflation numbers in the US, and we will cover those later. China, we had GDP growth numbers, and those were actually quite good, better than expectations. Okay, going through some charts.
So the Fed balance sheet is projected to decline slowly. It's not going to be undertaking QT, as Keith just said, and that means it'll be a slow decline. It's interesting that they have already they are walking back on their proposals to taper, and I just think there's an understanding that the US won't be able to sell the necessary treasuries if the Fed isn't there supporting the US Treasury market in some way. That's my view.
Yeah.
China exports growth year on year. China imports growth year on year. China balance of trade.
Well, and this is, highest it's been in absolute terms since this chart began.
China retail sales year on year, which don't look healthy actually. UK balance of trade, which never looks healthy.
Well, but actually, it has turned positive. It's rarely positive, and it's generally only positive when the UK economy is doing badly, and because we import a lot, and when we're not importing a lot, the balance of trade tends to turn positive. So actually, this is can be quite worrying. Let's watch this going forward.
Yes. Good point, Keith. UK GDP growth year on year, it's settled back down to a sensible level. Well, it's quite a high level, actually, 7%, I think. UK unemployment continuing to fall, tightening the labour market. UK CPI inflation continuing to rise, reference tightening labour market. UK core CPI. EU balance of trade, which actually looks very cyclical, that graph.
It does actually, but so it tends to December tends to be the weakest month, and that I don't think that's coincidence. Essentially, EU imports all its energy, and so with energy prices spiking, its balance of trade has actually turned negative for the first time in a long time.
The EU ZEW Economic Sentiment Index, which we've discussed. US retail sales growth, which is looking stable. US industrial production year on year. And then the US Empire State Manufacturing Index, which, as Keith has said, has taken a real dive.
I have added some commentary from Trading Economics here if people want to pause the video and have a read. Essentially, new orders actually declined in December. From previously, they're growing strongly. And also, you've had lengthening delivery times, and there have been comments about a lot of workers being off ill because of Omicron.
US housing starts continuing its upwards trend. US CPI inflation with that nasty spike. US core inflation with that even nastier spike.
Yeah, the highest since at least 1990. Before that, early 80s.
And US initial jobless claims, which seem to have stabilized now. US continuing jobless claims, which are still on a declining trend, possibly.
Yeah. Okay, on to Inflation Watch, and we've had a whole host of new data. So we now have December data for everyone we cover except for Japan. So, and it's all been not good, really. The rate of increase has declined, but all the numbers increased or met expectations. So the UK is now 5.4%, US 7%, EU 5%, Germany 5.3%. And those are the headline numbers. If we look at German producer price inflation, it is absolutely extraordinary.
So I remember a couple of, probably 5 or 6 weeks ago, referring to the Spanish PPI.
Yeah.
And that was 30%. At which point the German PPI was not at 30%. And it looks like this is a trend across Europe to me, that PPI is flying away out of control. And that will inevitably feed through to either businesses going bust or CPI going up.
Well, absolutely. I think CPI has to follow it. As we go through this, you'll see that European power prices are extraordinary. They haven't come down. They've come down from their peak, but we're talking about 4 times what they were last year. And that is going to feed through to broadening inflation and is going to cause huge disruptions to European businesses. Now, in the US, the unemployment rate, if you look at it in the long term, it is really approaching its lows from the late 90s, so lower than it was throughout the 1990s, throughout the 1980s. Now, I didn't have time to do it this week, but next week we'll be doing a piece questioning whether the Fed's model of the US economy is correct. But here, I would say that US unemployment is very low, even though its monetary policy and monetary conditions are extraordinarily loose. The Fed stated that its target is to get full employment back. And as you've seen from that chart, it looks like the US economy is pretty much back to normal, actually. So surely the US should start normalizing monetary conditions, which means rates would have to rise a long way.
But of course, we come back to the point, Keith, that it can't raise rates because it will completely crucify the economy, And it has to tread incredibly carefully and slowly.
Yes, no, I completely agree, Richard. But sadly, 2022 might be the year in which those contradictions cause huge financial ruptions.
Absolutely. Financial repression will coming out in the form of inflation.
Yeah.
And Hoss says US CPI, all items, less food, shelter, energy, and used cars and trucks. Or why have used cars and trucks suddenly come out? One wonders.
Because that's an inconvenient number, Richard. You know,
food, of course, we all know there's no food inflation, so you might as well take that out because it's irrelevant.
Yeah. So basically, you're trying to exclude transitory items, transitory spikes. And excluding those, you're still getting, accelerating inflation. And all this chart shows that now over 80% of CPI components are above their 5-year average. Essentially, inflation is broadening just as you would expect.
So sticky prices are also rising. So remind me what the definition of a sticky price is, Keith.
There isn't one. This is from the Atlanta Fed. They split up the components into components whose prices move quickly and prices components whose prices don't move quickly. And what they're saying is the ones that whose prices move flexibly, essentially, that's all time since they started doing this in the late 60s, moved at the fastest rate ever. And sticky prices are now moving as well.
US wage growth. I was reading an interesting little article this morning in the Financial Times, and it was talking about US trucking. And it says, here's another number that should spark concern. 17%. That was the annual inflation rate for overall trucking costs last month, 17%. For the long-haul trucking sector, the number was 25%. So wage inflation is just getting started, in my view.
Well, as we go through this, you'll see that despite the rises in wages, real earnings are falling because CPI is even higher. So, you would expect workers demand even higher wage increases to compensate.
And blue collar workers are benefiting the most. But I think, if you take your average white collar worker in New York who's working in a city law firm, you don't really feel sorry for him that he's got 2% lower in annual wage growth than your truck driver. Record wage growth for the young, which I probably think is indicative of the tightening labour market.
Yeah.
So although they tend to be less skilled, they are attracting a lot of interest from employers who are desperate to recruit.
Well, it shows that the demand is for people to just do basic things like, serve in restaurants, etc.
Yes. Women are doing better than men. I don't really know why this would be.
Again, I think the service sector, isn't it? Demand.
Yeah. And year-on-year PPI is still climbing. Well, of course, if it's going to look like German and Spanish PPI, it's got a long way to go. Yeah. And the interesting thing about these lines is that every year, every month, even the Fed was coming out and saying it's transitory, transitory, transitory. And look at this line. These lines are not transitory. And they're showing no indication of... So I think the lesson for all of this is your portfolio must be inflation-proofed.
Yeah, I agree with that.
We've been saying this for 9 months now.
But there were indications last month that PPI is slowing. So month on month, finished goods inflation actually fell.
Supply chain disruptions continue. And I think this is going to get worse because, of course, we've got the Chinese locking down for Omicron. Partly because of the Beijing Olympics, partly because Sinovac doesn't appear to work, partly, I suspect, because they've got Delta. And if Sinovac isn't working, we don't really know what Omicron does to a large population as a whole, because we've only really seen it in the West in a vaccinated population. And the suspicion is the Chinese population is not effectively vaccinated. So I think that supply chain difficulties are going to get worse, not better. So rents are rising steadily, but lagging. Rents are rising, but lagging CPI. So are they really measuring rents, or is this imputed?
This comes from a survey.
The figure is derived by phoning up a few householders and saying how much do they think they could rent their property for. So it's a hugely lagging indicator, and it's an indicator that it's fed by people who don't rent their property, so they don't know the answer.
So rent is a third of the US CPI measure. And as Richard's just explained, it's a big lagging indicator. So going forwards, as the rent catches up, so you see the growth in CPI tend to continue.
Yeah, and there's this fall in UK average real earnings, and which again is inevitably going to lead to wage increases and demands for higher pay. And you can understand it. But inflation around about 5%. If people are being offered 1% or 0%, and public sector, there's a huge public sector pressure for pay increases. Not just in the UK, but in everywhere where there's significant inflation. I think we are heading into a potentially stagflationary environment.
Yeah, I think you're absolutely right about the potential for political unrest, even in the developed world.
And it could unsettle even our hugely stable government.
Yes.
This is actually, I think this is a frightening chart, isn't it? You know, food price inflation in 2021. And
yeah, because if we now break down the components, so pause and have a look at this table because it's really shocking. You're seeing over 25% growth in food prices in 2021 as measured by the UN, and individual components were extraordinary. Look at vegetable oils. And in the US, IKEA is raising its prices by 9% in 2022, and businesses are going to now start passing on their very high input costs, and I expect to see inflation being persistent and broadening.
some good news, Keith. Where did this come from?
Yeah, now this, given the supply chain disruptions, you know, the commentary was weaker seasonal demand across all vessel segments, but actually the Baltic Dry Index has been falling for a few months now. So that implies to me that the supply chain disruptions in the form of difficulties of getting stuff through ports means that people are less keen to hire container ships. And also we know that actually getting hold of a container is quite difficult. So is this actually a function of the supply chain difficulties?
This is another one of those contradictory charts, isn't it, where it's hard to interpret it in the context of backlogs at container ports, other supply chain disruption that we know about, and record exports from China. It is quite hard to square that circle.
Yeah. Okay, onto the EU energy crisis. Russia not supplying Europe with as much gas this year. And we know that Russian gas production actually hit a record high last year. So where's the rest of it going? Has not led to a fall in gas supplies to Europe. You see here that the dark blue bar at the bottom is gas from Russia, and that is monthly data. And you'll see that throughout 2021, it was lower than in previous years, but the fall in Russian gas imports has been offset by LNG, which is the dark green and the black lines. And I thought this was absolutely amazing. So this is the path of an LNG tanker, which left the US Gulf Coast.
Turned round because someone offered a higher price.
Yep, it left the Gulf Coast, went through the Panama Canal, which costs several $100,000, got halfway to the Pacific, turned round, went back and came to the UK because we outbid their original customer.
That's fantastic, isn't it? And of course, it's a very expensive source of gas. It's a very effective source. It's very expensive. And it's price increases which have enabled, that have facilitated this turnaround in the supply.
Yep.
We're in competition with Asia, China for gas supplies.
Yep. Now, German electricity prices have come down from their peak, but where were they? Started the year at about 40 euros a megawatt hour. They're now at 165. So, they are 4 times what they were last year. So that is going to feed through to enormous cost increases for all European businesses, German businesses, and particularly basic material producers, which are very energy intensive.
But of course, the thing I don't understand about that is it's going to put European heavy manufacturing out of business.
Yeah. Unless, well, they're going to start lobbying government like mad now.
They are, aren't they? Yeah.
And this is UK electricity prices, which have come down from an enormous peak, but like in Germany, they remain way above where they were last year. Last year, they were, what, 130. They're now 194. This is UK natural gas prices. And we have as you've just seen from that chart of the voyage of the LNG tanker, we've been outbidding Asia, and our gas prices have come down to their peak, but they're still very high.
Turn your central heating up, guys. It's working.
A short segment on QE. Now, obviously, the US has had an extraordinary run in its stock market. Now, was QE responsible for that? And if we look at the increase in the Fed's balance sheet over the last, actually, 20 years, it's been extraordinary, and it's accelerated massively under COVID. And it will now reach a peak, but not really decline very much, because as we discussed earlier, the Fed is not going to sell its holdings. It will stop investing them.
One of the interesting things that we've commented on here in the past is the US house price inflation, which has been dramatic. And of course, you can see here very clearly that the Fed buying these vast quantities of mortgage-backed securities means that there's loads of funding available in the lenders to lend into the US housing market. So you have to question whether it was a deliberate policy to inflate the housing market to make the population feel more wealthy. And prima facie, yes, it was, and yes, it has worked. But it's like all these things; it's a bubble, in my view, that's been inflated. And how do you get out of it?
Yeah, no, I agree, Richard. I mean, the Fed has previously talked about the wealth effect and targeting the wealth effect by, pumping up asset prices. This is the total assets held by the Federal Reserve in purple, and the orange line is the S&P 500. And, just visually, there would seem to be a link. But when you then start looking at other markets, so the purple line here is assets held by the Bank of Japan, and the orange line is the Japanese stock market. There is a link, but it doesn't look so good. And the EU, well, the link kind of breaks down pretty much entirely, apart from during the COVID period.
I guess there's a question here, Keith. If you just go back to the previous slide, 1.8 trillion is a lot of money. But is it sufficient to move the needle? And is the relationship absolutely linear? But what you do see is that when the EC put the pedal to the metal, the European stock market.
But you don't necessarily know what the causality is there, Richard. The very fact they're pumping loads of money into the market and lowering interest rates and signaling that they're going to do so could have contributed to confidence. So, bottom line is beware of single factor arguments. The world is a complex thing. I mean, if QE had been responsible for pumping up stock markets around the world, then why hasn't, the Japanese stock market been a huge outperformer, given they've been doing QE now for, 25 years? Okay, and then on to another special section on the US dollar. Now, this is a live issue because the US, as we've covered in previous weeklies, is running a record current account deficit. Now, in order to balance its books, it then has to be running a balancing record capital account surplus. So where is all that capital account surplus going? Because the dollar index is not moving, it's stable, which suggests that the current account and capital account are in balance. And if you look at the federal debt held by foreigners, it really hasn't changed very much. So this is the quarterly data, and you'll see there were quarters when foreigners didn't buy any US treasuries at all. And then in Q2 2021, they bought a huge amount. Then Q3, they pulled their horns in again. So we know that a record amount of capital is flowing into the US. Where's it going? Well, This is US equities held by foreigners. And this is something we have covered before, but I hadn't actually got a chart of it. And there have been absolutely extraordinary inflows in the last 10 years as the US stock market has gone on this extraordinary run. Now, if the NASDAQ and technology stocks, which have pulled in a lot of foreign capital, now go into reverse, and the NASDAQ is now down on the year. In fact, it's now entered correction territory, down over 10% from its peak. And if foreigners now start to pull capital out of US capital markets, in particular the stock market, then the US won't be able to run an enormous current account balance because people will also be withdrawing capital. So the dollar will then have to fall, cutting US current account surplus until it is in balance with the reduced capital account inflows.
I think that that last graph is fascinating, and it just shows. I mean, if you look at that, you would think this has to be extraordinarily unstable, because we're talking $12 trillion here, which is half the US GDP. If that, if half of that comes out, then a quarter of US GDP flows out of the country in possibly a few months. I mean, wow, what does that do to everything? But I also think that what we're seeing is the financialization of the markets appears to have been, in my eyes of the policymakers, a closed system. And therefore, it doesn't affect the consumer. It doesn't affect you and I in our normal day-to-day business. But of course, it isn't a closed system. But I do think what it has been a slowly leaking system as opposed to a rapidly leaking system, which is why QE didn't affect inflation for many years. But if that rate of leakage starts to increase, it becomes a self-reinforcing cycle. And you could find that the massive financial inflation, financialization we've had, suddenly, like a dam breaking, and swamps everything as a sort of equalization process, which would mean that you get huge discontinuities in financial markets, massive inflation, breakdowns of correlations, and really, really big problems. And I just wonder, I'm not saying it's going to happen, but there is clearly, when you look at all of these extreme charts, there is clearly a non-negligible chance of this happening.
That's a cheery thought, Richard.
So I'm off now. I'll see you all next week.
Okay, so the implications of this, if foreigners start to pull money out of US equities as the NASDAQ bubble essentially declines, would be the US would have to run a smaller current account deficit because the capital account surplus would be falling. That would almost certainly lead to a fall in the US dollar. And the fall in the dollar would mean bearish for US dollar assets, bullish for emerging market assets, actually, because they have lots of dollar debts and those would be easier to repay, bullish for commodities priced in US dollars, bearish for US dollar rates, and bearish for US inflation. Okay, quickly on to China. Okay, so the Chinese property market, is that signs of a little uptick in activity? Construction activity stopped falling and floor space sold ticked up a little bit, but the index of Chinese property developer high yield bonds continues to collapse, not very encouraging. And this is something we covered earlier, but Chinese retail sales are really very disappointing. And there seems that we have now broken the trend of pre-COVID sales growth, retail sales growth. Doesn't look like the Chinese economy is doing terribly well at the moment, hence the huge exports.
So Keith, I think that the Chinese government is backpedaling on its desire to deleverage the property sector because it realizes if it does so, it's going to cause major economic damage. So it has inflated the bubble, and a lot of its magnificent GDP growth was through the inflation of that bubble, and it now can't afford to let the bubble deflate. And it a bit like the US Fed, but for different reasons, it's trapped. And understandably, it doesn't want to let that bubble deflate or burst. It is trapped, but the problem is it then saves it up for another day, kicks the can down the road.
Yeah, no, absolutely. You can see that in the fact they've started lowering rates. Other charts. So the market is now pricing in 4 rate hikes in 2022.
So that would be a 1% increase in interest rates.
Yeah. Where inflation is 7%, I'm frightened. Not. Now, Ukraine, this is the credit default swap on Ukrainian government bonds, and it ain't good. Essentially, the market is worried about a Russian invasion of Ukraine. Now, this is good news, and it shows that American households have very strong balance sheets. Their net worth, as the bottom right chart, has hit an all-time high, and their debt service ratios an all-time low. American households have the capacity to borrow and to spend. So when all the Omicron disruption passes, I am frankly expecting a strong economy. And on that note, US housing market, as in construction sector, looks very good. So the red line here is construction of 1-unit set structures like homes. Blue line is blocks of flats. And relative to history, they're looking very strong, stronger than throughout the whole of the last cycle. And as we've talked about before, construction is a big driver of economic growth, because when you move house, you also buy soft furnishings, durable goods, etc., etc. So this is very positive for the US economy. This is homes under construction. Again, strong numbers. But in contradiction to that, we know that house prices and vehicle prices have shot up, and these are US consumer buying intentions, which have kind of collapsed. So
the other question mark in my mind, Keith, is if the Fed stops buying mortgage-backed securities, does that make the availability of finance to buy properties harder, tighter, and therefore is that going to affect the US property market, and in due course the number of new starts will decline? Don't know, but it could be a consequence of it.
Yeah, something to watch. I mean, you've got push and pull here, haven't you?
Yeah.
That, you know, credit is still dirt cheap and deeply negative. The City Economic Surprise Index has turned negative again. Now, this isn't really very surprising given the COVID disruptions and the enormous number of people who are off work with COVID. So is this transient? We're just going to have to watch it. You notice I used the word transient there rather than transitory.
So on to COVID. So Britain's Omicron experience gives hope. This is the UK confirmed daily cases, and in white we have the confirmed deaths. Now we have an issue, new deaths per 5 days. We have an issue with deaths because, of course, a lot of people have COVID and are dying of other reasons, but they are recorded in the death with, as in dying with COVID, because you can't differentiate, I guess, easily the two. And clearly the death rate did not particularly follow the Omicron spike, as we all knew it wouldn't, except the people on stage. Both the Omicron spike and the death rate are now falling off. You know, I think Omicron has been good in terms of the pandemic because it's given us all, assuming we've had it, it's given us all a lot more immunity to coronavirus generally. Doesn't mean to say that another nasty variant won't pop up and cause problems. So daily new confirmed COVID cases per million people, and it's very dependent upon testing rates as well. I think people are somewhat losing the will to go and get themselves tested. In my experience in the UK, that's probably true. You think you might have it, but you think, well, I'm not going to get tested because it's too much hassle. That, not me personally, I hasten to add, but I have come across that attitude. You can see that they basically it's peaked everywhere except Germany and India on this graph. And as we've discussed, it hasn't led to a new spike in deaths.
Okay, on to the equity markets, and generally a bad week. So the FTSE All Share is down 1.1%, but the big dramas were in America, where the S&P is down 5% and the NASDAQ down 6.3%, and it's down 9.5% year to date and down over 10% from its peak. Bitcoin had a very poor week, which Richard will add some color to. And the sterling also had a bad week, actually. The NASDAQ has breached its 200-day moving average, leading to quite a lot of commentary. And a reminder, as we have covered many times on the weekly, that the NASDAQ is chock full of really overpriced, expensive technology stocks with a price to sales ratio greater than 10. And for example, something that caught my eye was Peloton, the maker of exercise bikes with an iPad attached. This is their share price, collapsed from over $160 to $24 and fell something like 25% yesterday when they announced that they were going to reduce their manufacturing because they weren't selling enough of them. And it has never made a profit, and it's still valued at $8 billion.
I think the issue here for me, Keith, is that you have to take a step back in it, and you have to think, okay, this is a company making exercise bicycles. To have a 50 billion valuation, which is roughly what it had at its peak, how many exercise bicycles a year does it need to sell? At what profit margin? And at what price? And you come up with, if it sells them for $1,000 each, then it has to sell 500 million exercise bicycles a year forever. I mean, It's just bonkers.
Yeah. I mean, honestly, so I looked at had a brief look at the financials. It's never made a profit. It's burning through loads of money. Its sales are now declining. It's still worth $8 billion.
And my son would put it on a price sales ratio of 1. Never mind a price earnings ratio.
Yeah. So honestly, I just don't think there's a bottom for these shares.
I don't think so.
And on that note, anyone remotely inclined to start buying the dip in the NASDAQ would do well to remember the dot-com bubble. When the shares of highly valued growth companies fall, they do not become value companies. They just become slightly less expensive growth companies. And when they start falling, they can fall a hell of a long way. So get out.
Yeah, I would put a proviso there, Keith. Get out and then get back in. The question is, when do you get back in? And I've got a chart a little bit later on of ARC, which I will talk about.
There are no bad assets. There are just bad prices. So when the price comes down enough, yeah, absolutely. So the cash flow yield on value stocks in the Russell 1000 is higher than the dividend yield on bonds. So that is a support essentially for equities. And I thought this was interesting from Research Affiliates. And this is their 10-year forecast for various asset classes. And they're forecasting strong returns for value stocks, but weak returns for equities overall and negative returns for cash. Sorry, Richard.
Particularly interesting, Keith, that the UK value is in there. And I was just looking at the chart of the FTSE going back 20 years. And in the last 20 years, the gain in the FTSE has been 10%.
Probably lower than inflation.
Oh, sure, yeah. Lower than inflation is now, Keith.
In the US, suddenly negative earnings announcements outnumber positive ones. And we know there are a lot of input price pressures on the US. We're now entering a period in which interest rates are rising. Now, what has been the historic experience? Have stocks tended to do well or badly when rates are rising? And actually, surprisingly, they tend to do all right. So this is a table showing periods in which rates have been rising, and the final column is the change in the S&P over the period, and you've had some very strong periods. And this is from Goldman Sachs, and the line here is the start of the hiking cycle, and the charts lines going forward of that is the performance of the index. And you'll see, generally, the market has continued to do okay with a wide range of results. So not necessarily something to worry about. Now, the Russian stock market has taken a huge bath because of the fears of Russia invading Ukraine. Richard.
So we're moving on to crypto now. And we noted a big fall in crypto in the table above, and it appears to have been precipitated by this from Russia. So the Russian central bank calling for a crypto ban. Under the draft proposals, Russia would ban crypto issuance operations, stop banks from investing in digital tokens, block the exchange of crypto for digital currency, and introduce legal liability for using crypto in purchases. Not sure what that means. So that has been another knock for the crypto market. Remember, the Chinese banning it a couple of months ago knocked it for 6. So that is the proximal cause of the drop that we saw in the last 24 hours.
Well, as we've discussed before, if crypto ever were to gain traction for use in transactions and actually start edging out the US dollar or at fiat currency, then sovereign nations would promptly ban it.
So this is Ether. I mean, this just shows the big drops that these things have had in the last few. This is a weekly chart. I thought it'd be nice to have a look at the long term. In fact, you can draw by eye. You can, if you want a bit of comfort, you could say, well, it's just come down to its linear trend. I'm not betting the farm on that, I hasten to add. And this is the logarithmic chart where it has broken through the logarithmic uptrend decisively. So that is tough, basically. And the Bitcoin is looking very, very similar. I mean, I don't know. This reminds me of sort of something. I'm not going to say what it reminds you of, but it's sort of double top, isn't it? And it doesn't look particularly healthy. And then I think we've got a couple of sarky comments from Keith.
Yes. Well put, Richard. Exactly. So essentially, just looking at the concentration in crypto, meant to be a new egalitarian currency, and actually, 95% of Bitcoins are owned by 2% of the accounts. And if we look at fraud, then credit card fraud loses the world the most money, but actually crypto fraud, stealing coins from their bank accounts, is the 3rd largest. So, who says it's safer than traditional fraud?
Can I just say that even Luddites like Keith are actually being drawn into the brave new world, because he now uses the phrase NFT with alacrity.
Energy commodities, right. So, in general, a volatile week. Oil was up a lot and has come down the last couple of days, but still, it's $84 a barrel in the US. Natural gas, Dutch futures is down heavily on the week. Coal up 8% and is up 33% in the first 3 weeks of this year. Amazing. And
so my coal mining shares haven't reflected that at all, Keith.
Well, stick with them, Richard. So this is crude. Frankly, that looks really overbought and probably due a bit of a pullback now. There are lots of oil has been puffed up by lots of geopolitical tensions. But this is the futures spread in Brent, and it's signaling the market is tight. So a positive number implies backwardation. That implies the current price is higher than future price, and therefore You want to be taking oil out of storage and selling it onto the spot market. And that is what is happening. It's saying the market's tight. Now, nominal prices are towards their top of the range in the last 10 years. But if we then look at real prices, i.e. deflated by inflation, then they're not, less concerning. And so far, energy prices in the US do not seem to be worrying chief executives who haven't been mentioning them in their earnings calls. Number one is labor shortages, and oil and gas prices hardly mentioned at all. A reminder, this is why I am very bullish about oil. This is CapEx as a percentage of assets, the dark blue line. And you'll see since 2015, there's been a real collapse in investment in CapEx. And so there's going to be an absence of new projects coming online in the next few years. But in the US, the Permian Basin is growing again. So shale is rising, shale output is rising, but it is the only shale patch which is growing. All the others have stalled or are falling. So you are not going to see the extraordinary growth in US shale production that you saw in the build up to 2015, for example. And remember that that essentially caused an oil price crash. Well, there's not the same pressures this time round. This is the most important crude chart. Essentially, it's inventories in the US, and you'll see that we start the year with inventories very low by historic standards. And watch this chart. If it continues to fall, then oil prices are going to go through the roof. On to Dutch natural gas futures, and they came down this week, but at very elevated levels.
So I just popped this these maps in. My European geography, or Eastern European geography, isn't great, and I just thought, where is the Nord Stream gas pipeline in relation to Ukraine? And you can see, in fact, it is a long way away from Ukraine. It comes down through the Baltic Sea into the northeast corner of Germany, above Berlin. And so geographically, any problem in the Ukraine shouldn't affect Nord Stream, although I think it might be fed by gas fields from the Ukraine. I just thought that was interesting.
Well, of course, when you say it's not going to be physically affected by events in Ukraine, it will be politically affected by them.
Absolutely, yeah.
This is worrying for consumers of natural gas because the Chinese have discovered it and now become the world's top LNG importer. So the orange bars are Chinese imports of LNG, and they've been growing steadily, and they've now overtaken Japan. So essentially they've outbid Japan. Coal rising rapidly, and sadly for the world, Chinese coal output hit a new high. They're burning more coal than ever. Uranium come off a bit, but near its highs. Okay, on to industrial commodities. Richard.
Thank you, Keith. So some very big movers this week. I'll just go through the bigger ones. So aluminium up 5% and 10% on the year, and cobalt, a significant increase of 2%. Lithium, 22% on the year, 6% on the week. It's just marching upwards at an extraordinary rate. Magnesium come off a bit, or quite a lot actually. But if you remember last year, it went up very dramatically. Neodymium up 14% all this week, which is a big rise. And nickel year to date is up 15%. Again, a very big rise and continuing its trend. Tin up 10% year to date, 6% in the week. So some big moves in industrial commodities, big positive moves in industrial commodities here, which will feed through into inflation. And aluminium is, I personally expect the price of aluminium to go significantly above that peak at 3,200, just on the basis of everybody saying that it is in short supply. and there is a reduction in production. So I am personally quite bullish on aluminium, and as people will recall, a couple of weeks ago I bought some aluminium. I say bought it, I bought some aluminium on IG index, and I am planning on holding it for a few months.
Very good. Well, I'm also bullish, Richard.
So cobalt, yeah, there's a cobalt chart. Copper, been steady now for many months. Chromium is falling back off its massive rise. Iron ore steadily climbing.
Yes, here I put a question mark beside our idea of Ferexpo, which is a big iron ore producer in Ukraine. So its share price has come down a long way, but it's probably not a very good idea to buy it at the moment until tensions ease.
Just going upwards. Magnesium, it's sort of regained its mojo a bit, hasn't it? But it's fallen off a long way from where it was in September. Neodymium, clearly. I mean, what surprises me about this is that we did a share talk a long time ago on rare earth metals, and neodymium is not forecast to be in deficit now or ever, I think. If I'm correct, please correct me if I'm wrong, but the price is suggesting that isn't the case.
Rare earths aren't rare, but it's a question of how quickly new supply can be brought online. So, there are a lot of projects in the pipeline, but I don't think most of them are actually producing yet. So there's this short-term squeeze. But as those projects start coming online, I think there's not going to be a shortage.
Nickel is soaring away. I don't know if there's a particular reason for that.
In previous weeks, we've covered how inventories were falling at all the metal exchanges, and nickel is a big component of batteries, and battery metals are all steadily climbing. But we're also not expecting a deficit this year. We're expecting a deficit in future years, but currently the market, according to commentary, is quite well supplied.
Tin continuing its inexorable and steady upward trend. Ferrovanadium pretty much flat really for the last few months.
Okay, on to precious metals, Richard.
Yeah, so all the precious metals had a decent week actually. Silver had a particularly good week, up 5%, platinum up 6%. Rhodium is just incredibly volatile at the moment. It would be up and down 8 or 9% a day. And palladium has had a very good week indeed. So this is a weekly gold chart, and I'm not very good at drawing wedges because I don't really know where to put the top line. I find the bottom line easier. But by my wedge, gold has broken out of the wedge, and it's also above the 3 moving averages that I've got there, 20, 50, and 100-day moving averages. And you will not be surprised to know that, given my comments on inflation and financial disaster, I am bullish gold. So this is a Sprot's Gold Bullion Positioning Index. And basically what it's saying is that positioning in gold bullion is very pessimistic. And as we know, generally speaking, best time to buy an asset is when everyone else is pessimistic about it, provided that you are right in your reasoning that they're pessimistic for the wrong reason. Big proviso. And so this is the price of gold versus a federal funds real interest rate, which I thought was quite interesting. Now, these correlations are always pretty tricky to pull out by eye. But what you can do is, if you look at the line, is the gold price. And you can see that 1971 to 1981 gold price spiked significantly in an environment where there were points where there were fairly significant negative, on the right-hand side, negative real interest rates. And then in the next 20-year period, there really weren't any negative real interest rates, and gold didn't do much. And then since 2004 or so, there have been significant periods of negative interest rates, and the gold price is going up as a trend generally.
Yeah. Well, gold tends to do well in periods when there's a lot of financial uncertainty. And frankly, we might just be entering one.
And this is the last little table I put in, which just compares gold miners, the GDM, which I think is an ETF, or it's an index, isn't it? I think, with S&P 500, and you can cast your eye down there, and you can see that actually gold miners, the GDM, is outperforming in all of these metrics, outperforming the S&P 500 in every one of them, which is a good reason, I think, to have a holding of gold mining, the right gold mining equities.
Yes. Now, in previous weeks, we've covered that I've actually sold the vast majority of my gold miners after looking at the accounts of Centamin, the Egyptian gold miner, and they're suffering big margin squeezes because of the rise in energy costs. But I have kept hold of Goldplat, which it recovers gold from mine tailings, amongst other things, and was less exposed to spike in energy prices.
So price of silver, I mean, I think silver for me actually needs to get above that top line in order, at which point I would say it has a good chance of striking up towards the $50 point. It has had a good week, but it's not there yet. Platinum and rhodium and palladium.
Okay, finally on to rates, and a reminder, UK CPI is currently at 5.4%, December numbers. RPI, that's the old way of measuring inflation, 7.5%. And in that context, UK bond yields are rising, but the 30-year yields 1.32%, the 20-year 1.4%. Yields are still very strongly negative. In moving on to the Eurozone, yields have been rising, but again, are really, very low by historic standards. The Greek 10 years at 1.68%, Italian at 1.4%. Not worrying levels, frankly.
I'd also just pop back to that. Spain had this PPI figure of 30% not that long ago. It simply makes no sense.
Absolutely. And on that note, Richard, so this is the deficits and the debt burdens of G7 nations. And the top here, this is the total debt as a percentage of GDP. The red line is Japan, which has debt to GDP above 250%. The next one down is Italy. Now, if Italy suffers a financial crisis, rising yields, investors lose confidence in Italy, then it is too big to be saved by the ECB. Watch this space.
And the other thing, Keith, I would say is that Reinhardt and Rogoff did work that said that basically if debt to GDP ratio is greater than 90%, then additional debt had no effect on economic activity. In fact, we had a damaging effect on economic activity. And all of these countries are well above that 90% figure.
Yeah. These are historic forecasts from professional economists as surveyed by the US Fed. And you'll see their track record just ain't good.
What's interesting here, Keith, is that all of the dotted lines appear to come off the real line at about 90 degrees. It's like maybe they're just using a protractor for their estimates, and it's extraordinary how you would expect it to be maybe a bit more down and slow, gentle. No, they're going to change direction like that.
Yeah, you're right. Actually, the chart, the angle of their forecast always seems to be the same.
Yeah.
So
they are using a protractor, Keith. That's it. And they're earning a fortune because they know how to use a protractor. Oh, nice work if you can get it.
Yeah. being a professional economist seemed to be a remarkably easy job. This is the Greek 10-year rising,
In
Italian.
the scales on the chart on the right-hand side, they're missing a zero, Keith. They're out by a factor of 10, aren't they?
Well, yeah, you'd think they would be, rising. This is the UK 10-year. Now, dropped over the last day because of the ructions in equity markets. The same in the US. On to the seasonality chart. And according to the seasonality chart, the early falls in stock markets will be reversed towards the end of this month. So, watch this space. Richard, what have you been up to this week?
Thank you, Keith. So I had a good week, actually. I was up 4.2%. That's just, I missed over the last fortnight. If you remember, the first week I was down 1.4%. So I'm up 2.8% for the year. And I believe the FTSE All-Share is up 0.5%. And the fundamental reason for that was my higher weighting to commodities and precious metals, which have, as we know, as we've discussed, have done well. My exposure to Bitcoin, actually I'm not exposed to Bitcoin, but my exposure to crypto slightly crimped the performance. No purchases and no sales. I've been admirably self-controlled and sat on my hands. There's a couple of things I just wanted to mention. So some time ago, I bought Garibaldi Resources, which has a large nickel sulfide resource in Canada, I think. And I bought it in early 2021. I can't remember the exact price, but it was around about here. And it did appallingly. And I hung on in there. And suddenly, with the increased interest in the nickel price, I'm now pretty much break even on it. And the reason I'm raising this is because these small resource companies, and Keith has another tale he will tell, but these small resource companies are very volatile, and you do have to ride out the volatility. Otherwise, you end up buying high and selling low. But part of that means you have to have the right size position in your portfolio so that you're comfortable in riding it. And then I mentioned a few weeks ago cannabis, and Keith thought I was probably smoking it, so I want to mention it. But I am still advising, and I'm still watching, keep an eye on the Advisor Pure Shares Cannabis ETF. And I think this trend line, this trend channel is really useful, and it sort of poked its head above it and it's gone back inside it. And I'm using this as a sort of trigger to indicate I may want to buy some, because I do think that cannabis shares will one day take off again, but clearly not yet. And then the last one I wanted to put in was the ARK ETF. Now, I think the ARK ETF is a buy. The only question is where, and I suspect it's a buy at around about 4,000. So when it halves from here, I think it might well be worthwhile buying some as a long-term investment. But I think I'm reserving my judgment until the time and what's happening with the market. But obviously, it's not a buy now.
Yeah.
I believe that that's what I wanted to cover this week, Keith. Deeply
skeptical, Richard. I think the thing is, when ARK falls down to those levels, they tend to undershoot. Yes. Basically, people have loss aversion at that point, and won't be.
So maybe something, Keith, you're quite right. Maybe something that you either get into very slowly, or you think, well, I'll watch it for 6 months, a year, see where it goes. But you can't write off the whole sector. You can't write off the tech sector. And it is a good representation of the tech sector.
Yeah. All right. I mean, I've seen what's in ARK,
You're not convinced.
No, pained expression, frankly.
What's happened with you this week, Keith?
Okay, I had an indifferent week, down 0.1%. But I'm up 6.9% year to date, and that means I'm outperforming the all share by about 6.4%. Now, I'm afraid we had some we had a bit of a disaster this week in Advanced Energy, which I covered in my last share talk, and was drilling and should have been an appraisal well into an old oil field offshore Timor-Leste. Now, the CPR, which was produced by an independent consultancy, the Risk Consultancy, put the chance of discovering economic quantities of oil at about 95%, and the CEO had described it as being almost inconceivable they wouldn't find commercial quantities of oil. And the CEO and the chairman had, between them, put in 430K to the fundraising, so they had skin in the game. Well, it looks like they found nout. They found an oil column of around 12 meters when they're expecting anything up to 80, and it is very questionable whether there's going to be commercial quantities of oil there. The shares fell 85% in a day. Now, I have been in the stock market for 30 years, and I can't think of another company whose share price has fallen by 85% in a day. Really shocking. So after the end of this weekly, Richard and I will be doing a My Worst Trade on Advanced Energy, where I will be considering the lessons to be learned. And I think there are some very important lessons to be learned. Will not be a knee-jerk reaction to this loss, but we'll be considering how to implement the lessons from, after every big disaster, I like to sit down and think what I should have done better. I think there's some key takeaways. Now, that gave me, that one position lost me about 0.8% of my portfolio. So it is survivable, but it is nonetheless very annoying. And I know a lot of our Discord members suffered significant losses. Now, I had one small purchase this week, which is Savannah Energy. Now, lots of our Discord members are very keen on Savannah, and I had previously avoided it because it's got assets in Nigeria and Niger, where there is an active jihadi war going on. And it's in the process of acquiring ExxonMobil and Petronas's assets in Chad and Cameroon, which are not the safest part of the world either. So conviction, 2 out of 5, and weighting 0.3%. And this is Advanced Energy. Not a happy chart. And this is Savannah Energy, which has been doing very well recently. But if the economics of its acquisition of the ExxonMobil and Petronas assets is to be believed, then the shares look very cheap. And that is it for this week. Thank you very much for watching to the end. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.